The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Right, Friday the 2nd of August. Hi, Jeremy.
Hi, Gareth.
Good to have you back. It feels like it's been a very busy week with lots of news on the macro front, interest rate changes and all sorts of things going on, so government-wise and central banks, and also some quite big moves in some major stocks, especially in the tech sector. Do you want to run us through what you've been seeing and what you're drawing from it?
Yeah, I mean, as I think we flagged last week, it has been a very busy week for economic data and macro news. In the euro area, we had GDP figures, which showed that the euro area economy grew in the second quarter at 0.6%, with its largest single economy within that, Germany, registering a negative 0.1% performance over the quarter. And at the same time, the Eurozone inflation figure for July year on year actually increased to 2.6% versus an expected softening to 2.4%. So while most of the action has been outside the euro area, there does seem to be a marginally stagflationary backdrop emerging in Europe, which is a bit unsettling.
Okay.
But the big news this week has been on interest rate policy. First of all, we got a bigger than expected rise in rates coming from the Bank of Japan, who raised their guided policy rate from 0.1% to 0.25%. And although incredibly low by the standard of any other country, this is the highest level of policy rates in Japan since 2009.
This is something you've been talking about for a while, isn't it? Japan being a potential time bomb or something to catalyse trouble.
Yeah, it's an outlier and it's increasingly becoming an unsustainable outlier. And as Bloomberg reported this week on the announcement that this decision would likely send ripples across the financial markets, given the yen's status as a major carry trade currency.
Yeah.
As I've spoken about before, the US dollar yen rate has been volatile for a while, but broadly year to date, the yen has weakened significantly. But now we've got this narrowing of the rate differential, and it's becoming significant now between the yen with rates going up and the dollar, where the perception is and the reality is going to be that rates are coming down. So the yen is now strengthened to a point where it's now below the 150 level.
Okay.
So financial repercussions of this are ongoing, but it's obviously coincided with some interesting moves in equity markets. And as saw overnight, the Japanese equity market fell 6%, which is a big move.
It's a massive move, yeah.
But back on the interest rate front, later on Wednesday, we got news that the Federal Reserve will be keeping their rates on hold, but with the strongest hints possible that they would look to cut rates in September. And they certainly gave the Bank of England confidence on Thursday to follow suit of some of Canada and certain other markets where we didn't wait for our normal cue from the Fed and we cut policy rates by 25 basis points to 5%. And this is the first cut we've seen in interest rates since 2020. We've seen a weakening of the pound, although it's stabilised, it's not been significant. But what has been significant, both in the UK and the US, but particularly in the UK, the 10-year bond yield, 10-year gilt yield has now fallen decisively below 4%. And this is heading towards the year-to-date low for 10-year gilt yields. And I think that's probably pointing to a cutting cycle, I would guess, of around 100 to 150 basis points from here, probably over the next 18 months or so.
Okay, so that's your UK view.
UK base rates, yeah, I would say heading towards below 4% for sure.
Well, that would be welcome news for the house market, wouldn't it?
Yeah, and just sort of in part recognition of that, UK house prices as measured by the Nationwide increased year on year in the month of July by 2.1%.
Okay.
But just sort of moving on the macro stuff, it's been jobs week in the US. We've had the JOLTS job opening data confirming an ongoing weakening trend in jobs availability. And of course, later today, we'll get the notoriously volatile and difficult to judge non-farm payrolls. But I think a sharply negative non-farm payrolls figure would be particularly unwelcome to a jittery equity market right now. And in that environment, safe havens such as bonds, gold, and the dollar have broadly strengthened, or the dollar not so much, also reflecting rising tensions that are going on. Obviously, the Middle East is becoming more difficult to judge and more complicated.
Yeah.
I don't think markets are particularly panicking over this state of affairs, tragic though it is. I think the oil price has been bubbling along at lower levels. It's recovered from a very low level. I think the oil price has been on a weaker trend, meaning that energy costs more broadly remain below the sort of inflationary threshold. Fears of recession have definitely taken hold over fears of inflation. And those fears of inflation could roll forward into fears of deflation if things carry on as maybe indicated this week. But back in equity markets, Microsoft reported its quarterly figures, and lots of other companies did this week. But Microsoft in particular, their update was taken negatively around its cloud revenue growth, growing at a mere 29% year on year. That furthered Nasdaq's weak run. And although there's been one or two bright spots like Meta and Apple, Nvidia, the bellwether stock of the moment on Nasdaq, has been incredibly volatile, moving on average between 5 and 10% on a daily basis. And I don't think it's just a matter of concern for equity investors. I think this will be a matter of concern for policymakers as well.
Hence the Fed wanting to think about how they're going to position the messaging when they meet in Jackson Hole before they do whatever they're doing with rates into September.
Absolutely, yeah. What I would reflect on is that I think the global economy is still slowing. We haven't talked about it, but China had another lower than expected manufacturing data point this week, with a PMI data coming in below 50 for its third consecutive month. And this is helping to subdue inflation and allowing central banks to reduce rates, which is obviously good news. But the episode that we saw in the UK in the House of Commons at the start of this week, I'm referring to Rachel Reeves' revelation of the £20 billion black hole in the UK Treasury, highlighted the conspiracy of silence that I think has existed for too long regarding the fiscal position of rising debts and rising debt servicing costs that affects nearly all Western countries. That is now appearing on radar screens of probably every newly elected government. And I think this is going to be particularly the case after November. Whoever wins the US presidential election, they're going to have what I would term a freight train called debt heading towards them at full speed. So without wishing to be too alarmist, we do live in a world of what is called fiscal dominance. And these are the issues that are going to make this sort of future path of lower inflation, lower interest rates be not in reality an easy path to follow.
That's an interesting point. So fiscal dominance. So that's essentially saying that government spending is removing the ability of the supposedly independent central banks to control inflation through the interest rate mechanisms. Why do you think we're in that situation? What is it about the current setup that's meaning that government spending is holding all the reins?
It's not so much the amount of government spending, but the way they choose to finance it. And I would argue that the ultimate problem rests with politicians who aren't honest with their electorate about the manner in which their spending commitments are to be financed. The US is at the forefront of this because it's able to borrow more than anybody else. The US public spending deficit is running at somewhere between 6 and 7% of GDP. So there are a number of fiscal issues that are building up in the latter half of this year into 2025 that are going to face any incoming US administration, assuming we've worked out by then who actually is going to win the election or claim they've won the election.
Indeed. Wow. Okay. So early next year could see a major need for US debt refinancing coinciding with a need to renegotiate the federal budget limits.
Yes.
And a potentially febrile political landscape, depending on who claims they've won or not won the election. Well, it's going to be fascinating to watch that play out. So, yeah. Closer to home.
Yeah. On the UK, what have you been looking at?
So there's been a flurry of news from UK stocks. I'll quickly rattle through some of the major ones from the Progressive client standpoint. At the back end of last week, we initiated coverage of a company called Vanel. It's a short 50 million market cap provider of foundations for new build properties. Obviously, they'd hope they'd be a beneficiary of the new government's push for more housing. And our note focuses on that and a number of other exciting dynamics within the Vanel story. So that's one to watch as the Labour government gets into full speed with its housing plans. Other news, we had Xaar, which is a manufacturer of print heads in that market. They had a nicely inline trading update. SDI Group talked about some resilient performance, and they've got a strategy refresh going on under the new chief executive, Stephen Brown. So interesting things to look for there. And then we had a slew of news from other building and construction-related stocks, Watkin Jones, Forterra, and Severfield. And the general theme is that conditions are tough, but they're not worsening. And with these government initiatives coming through seemingly quite quickly from Labour, they're not wasting any time. I think most people in that sector are really starting to see the light at the end of the tunnel. Also had a chance to catch up with FDM Group that we look at through one of our broker relationships. And they had a set of half-year results reported during this week. And they were talking about, yes, market conditions still being tough, still challenging to get projects signed off. Their clients are generally very large insurers or financial services organizations or government sector. And so project sign-off has been difficult, and their results reflected that. But interesting that the chief exec, Rod Flavel, he's now talking about the metrics around how FDM is positioned for recovery. He talks about it costing £5 million to train 500 consultants, and it takes 12 or 13 weeks. So he's sort of got the metrics set in his head for being able to pitch some quite big opportunities to major corporate customers. And simply the fact that he's talking about that, I don't think that was where FDM as a group was 3 or 6 months ago. And so I think there's a shift of mindset there. So across most of those UK pieces of news, there are signs of optimism.
Yeah. All those companies you talked about, I would regard as mid and small cap bellwether stocks in their own way for a UK economy that is doing relatively well in a difficult global environment. The great rotation away from large cap tech to small cap value continues to play out in global equity markets. And we're seeing it in Wall Street, we're seeing it in Europe, and we're definitely seeing it in the UK, should be to the benefit of these type of companies. And I think that was reflected in one of the results that I thought was significant this week was the private client fund manager Rathbone. They were saying the outlook for flows in the short term is improving as client confidence to invest increases, helped by a more certain UK political backdrop and lower inflation. So I think its relative position in global markets, the UK is looking in good shape. If you're a global investor and you're having to park some capital on a multi-year view, the UK is not a bad shout right now.
Oh, absolutely. And if the sentiment from those companies that we saw this week, if that's echoed more broadly, which I think it probably is, that's not a bad place to be at all. So, yeah.
Okay.
Good. Well, we'll keep an eye on it. Thanks very much. Next week, is there anything dramatic? It looks like quite a quiet week.
Thankfully, it's much quieter next week. We get some US PMI data. We're hoping for a bit of a recovery from last month's weaker than expected showing for services PMI. And there's some trade figures and some inflation figures out of China. I think it's going to be a quiet week. I don't think it's going to be particularly consequential. I think the next macro setup is likely to come out of Jackson Hole later this month.
Yeah. Okay, good. We'll catch up next week and take it on from there.
Okay.
Thanks a lot.
All right.
Cheers.
See you next week.
Brought to you by Progressive Equity.